Everyone, we are the interns at Dorsey Wright & Associates. I'm Joseph Grimm, go to Virginia Commonwealth University. This is Charlie Shiplet, he goes to University of Virginia. And Ben over here, Virginia Tech. So today, we're going to talk a little bit more about ETFs. I know we touched a little bit on it last time in the video, but we wanted to go a little bit more in depth and kind of do a full segment on it because it's a really exciting product.
Yeah. I think, Joe, you had a great analogy last time with schools of fish and kind of explaining the basics of an ETF and how it works. I think you should elaborate on that a little bit more.
Definitely. Sure. Well, ETFs are one of the most exciting products that have really been brought out to the market in finance in the last 20 years or so.
It's exploded.
What it really does is it democratizes the whole investment process because it makes it really easy for the individual to get in and get exposure to areas or invest in ways that previously would not have been accessible to them or would have been really intimidating.
Right.
So kind of what you were talking about before with the school of fish versus the individual fish, obviously if you have an investment portfolio, you can go out and you can buy 10 different stock companies. Or, depending on how big your portfolio is, maybe you can only buy a handful of stocks. Mm-hmm. Well, instead, by using an ETF, which is basically a pooled portfolio of funds, which means that you give your money to this company, they pool it together with, thousands of other people who've given them money, and they use the whole portfolio to invest in a variety of investments.
Right.
So with the same amount of capital that you had before, you can get much better diversification because that's being spread out over a variety of other investments.
And not only do you get diversification, but more importantly, you get transparency. With the democratization of these exchange-traded funds, the average investor, for instance, like a college kid or a father who is like trading online, he's able to see what stocks are actually in these ETFs. When you invest in a mutual fund, you go to their website, you might not know what the money manager is actually investing in. Yeah. And that's what's great about these ETFs. You just go on a website and you can actually see the holdings, and it's just fantastic.
And a lot of them are updated daily, so you can see exactly what the weightings are on any given day. But the real beauty of it is, say, you're not the savvy stock picker like Ben here, so maybe you feel good about a company, but maybe you don't want to put all the money down on that one horse.
Right.
Well, you can buy an index where that company is. You can buy an ETF that invests in an index that company is part of, but it's not the only thing there. Okay. So it's spread off over the group in general.
Or you can take that idea and take the opposite perspective, both of which are good ideas. And you can say, well, I like the idea of global warming, and I think there's going to be a lot of investment opportunity in an idea like that. So you can take a global warming ETF and invest in that, and essentially you're investing into the new companies that are producing energy-efficient products, new types of energy, wind energy, and things like that. And you don't have to take the risk of investing in one specific stock. And you're, like you said, it goes back to the diversification.
And if you don't believe that there is such a thing as global warming or that alternative energy is the way to go, you can invest in energy ETFs that focus on oil and oil companies,
right,
equipment, drilling services, so you can take the alternative stance.
Yeah.
So there's endless opportunities.
We should get back to the specifics maybe in the next one, though. So let's stick to general right now, though. So far, the way we've described it, we make ETFs sound a lot like mutual funds, and they are, but there are some important differences to be aware of, too, which is what, in our opinion, makes the ETF really an exciting product.
Okay.
Namely, when you invest in a mutual fund, you send the money off to the fund company itself,
right,
and they hold on to, that. And all transactions are done between you and the fund company.
Right.
So when you buy shares, you send money to them, and when you sell it back to the fund company, and they give the money back to you.
Right.
With an ETF, basically what that means is there's no secondary market for mutual funds. Okay. So if I hold shares in a mutual fund, I can't turn around to Charlie and say, hey, I want to sell my shares to you, so you give me some money and I'll give that to you.
Right.
You have to go back to the fund company if you're interested. Mm-hmm. Well, ETFs are different because they're traded on an exchange, and they're traded in real time, which means instead of one settling price for the whole day like you have for a mutual fund where all the transactions are carried out, you have it trading throughout the day just like any other stock.
So it's fluctuating in price compared to a mutual fund, which only closes out at the end of the day. Is that what you're saying?
Exactly.
Okay. Yeah.
And it gives you a lot more flexibility too, because instead of just having to go back to the fund company, you can turn around and sell it to other people, which makes it more liquid in general.
It's a lot easier. It's publicly traded, and you can go on to just your normal TD Ameritrade type online account and purchase it through there, rather than, like you were saying, having to go through a mutual fund house and going through a lot
Sign
of
up all kinds of paperwork.
sorts of paperwork, going through brokers, giving a lot of people different expenses. So it's a real efficient way into investing in the idea of a mutual fund or a broad index or something like
Now,
that.
I've been hearing that ETFs are a lot cheaper to invest in than mutual funds. Why is that?
Well, one of the reasons is because it's an index-based product rather than an actively managed product.
Okay.
So the way that we typically think of a mutual fund in terms of an active investment means that there's one guy sitting behind the portfolio, or a team of guys,
Right.
and they sit down and they say, I think these stocks are good, this is what we're going to invest in. So they pick those. So the performance of the fund is based off the quality of those managers' picks in terms of which investments they decide to take on. So that's different from a indexed product, because whereas that has generally higher trading costs because they're trading in and out of things during the year.
Okay.
The index product is much more stable. So you look at an index like, I know it's kind of maybe a term they're not familiar with, like the S&P 500 or the Dow Jones Industrial Average. They've probably heard of those.
Right.
Those are both indexes. And the beauty of ETFs is that every ETF that's out there right now is based on an index. And all of those indexes are constructed with very objective rules. There's very little subjectivity at all.
Yeah.
Meaning that every index that's out there, there's a reason why the set of stocks or other products that are part of that index are in it. And when one is taken out, another one will be placed, and there's going to be a reason for it.
Yep.
So as long as you agree with the underlying methodology of how the index is constructed, then you'd be amenable to using that ETF product.
Right.
So it reduces costs because there's not going to be as many changes in the index over time, theoretically. So it's going to be more stable.
Yeah, and one more point, real quick, is you're not paying a manager's fee.
Yeah.
When
That's
it's
true,
with
too.
ETF, they're going to take 100 basis points at least, which is 1% of whatever that mutual fund makes, and you don't have to change that, pay that. So that's putting a lot more money in your pocket. I think we're going to wrap up this segment. We talked about ETFs, the different ways you can invest in them and things like that. And I think in the next segment we're going to go into a little more specific ways on how to use the ETF.
Yeah, we're going to go into the strategies of how you can invest them. You know, we talked about why they're great ways for young investors to utilize them in their portfolios. And I think if by engaging in a discussion on the strategies, I think the average investor will know how to use them better than before.
Yeah.
So let's go ahead and switch over to take two.